Have you ever wondered why some people quietly build massive wealth while others struggle forever? What if I told you most people invest in completely the wrong places? Imagine working for decades, yet your money barely grows beyond inflation pressure. Now think about someone investing early and never worrying about money again. Why does the gap between rich and average keep getting wider every year? Most people follow advice that feels safe, but actually limits long-term growth potential. The real secret is not how much you earn, but where you invest it. In 2026, financial markets are changing faster than most investors can understand. Artificial intelligence, global shifts, and inflation are reshaping how wealth is created. Yet most people still rely on the outdated strategies from decades ago. What if the biggest opportunity of your life is happening right now, unnoticed? Today, you will discover investment paths that wealthy investors quietly rely on. Some of these choices may completely challenge what you believe about money, because the truth about long-term investing is not what most people expect. And once you understand it, your financial decisions may never be the same. Long-term investing is not about luck, but about understanding powerful compounding forces. The richest investors think in decades, while most people think in months. Historically, stock markets like the S&P 500 reward patience over emotional decisions. Even small investments consistently grow when left untouched for long periods. Real estate remains powerful because it combines leverage, income, and appreciation potential. However, it requires capital, management effort, and strong location selection discipline. Meanwhile, index funds quietly outperform most individual investors over long time frames. They spread risk across entire economies, reducing dependency on single companies. Bonds provide stability and predictable income during uncertain economic cycles. They may not create excitement, but they protect wealth during market downturns. Gold continues to act as a hedge against inflation and the global instability. It does not generate income, but preserves purchasing power across generations. Cryptocurrency introduces high risk, but also extreme upside potential for early adopters. However, volatility makes it unsuitable as a primary long-term investment foundation. Successful investors combine multiple assets instead of relying on one strategy alone. Here is the surprising truth most financial advice completely ignores today. The real enemy of wealth is not risk, but emotional decision-making. People lose more money reacting emotionally than by choosing bad investments. Even the best assets fail when investors panic during temporary market crashes. Timing the market consistently beats timing the market in most scenarios. But here's what changes everything about long-term investing strategy today. The future is not about picking winners, but owning entire systems. Index funds, global ETFs, and diversified portfolios represent that system-level thinking. Meanwhile, emerging sectors like artificial intelligence are reshaping global productivity forever. Investors who ignore these structural changes risk missing massive future opportunities. At the same time, overconfidence in hype sectors can destroy entire portfolios. Balance becomes more important than prediction in uncertain economic environments like 2026. Diversification is no longer optional, but essential for survival and growth, because no one can consistently predict which asset will outperform next decade. The real secret is staying invested while others constantly switch strategies. Think about your daily spending habits and where your money currently goes. Most people spend more time choosing phones than choosing investment strategies carefully. Yet financial decisions shape decades of their future lifestyle and freedom. Imagine two people starting with the same income at the same age. One invests consistently in diversified assets while the other delays every decision. After 20 years, their financial outcomes become completely different realities. This difference is not intelligence, but discipline and long-term thinking mindset. Even small monthly investments can become life-changing wealth over long periods, but consistency matters more than the amount you start investing initially. Market cycles will always create fear, excitement, and moments of uncertainty. Smart investors stay focused during both extreme highs and deep market lows, because wealth is built silently while most people are distracted elsewhere. The greatest financial advantage is patience combined with consistent strategic investing, and that advantage is available to almost everyone willing to start today. The question is whether you will act or continue delaying your future. Long-term investing is not complicated, but it requires discipline and clarity. The best investments for 2026 are diversified, balanced, and globally structured portfolios. Stocks, index funds, real estate, bonds, and gold all play different roles. Each asset protects you from different types of financial uncertainty and risk. No single investment guarantees success, but diversification increases survival probability significantly. Wealth is not created by guessing trends, but by staying consistent long term. Every year you delay investing is a year of lost compounding growth. Even small decisions today can transform your financial reality in future decades. Start by building a simple diversified portfolio aligned with your risk tolerance. Focus on consistency rather than chasing quick profits or market predictions, because financial freedom is built slowly, not through sudden lucky moments. The earlier you start, the more time compounding works in your favor. Your future self will thank you for the decisions you make today. And the best time to start building wealth was yesterday, but next best is now. Take action today, because opportunity does not wait for perfect timing.